We've got a packed show for you, with plenty of news and analysis from the financial markets. Let's start with the latest developments in India, where the stock market has been experiencing some significant volatility. The Sensex has fallen over 250 points, with the Nifty slipping below 24,250 as hopes for a peace deal in the Middle East continue to fade. This downturn is being driven by a range of factors, including escalating tensions between Iran and the US, which have pushed Brent crude prices above $91. At the same time, the U.S. 10-year bond yield has increased to 4.73%, which could negatively impact foreign investor inflows into the Indian market. Despite these challenges, there are still some positive signs for investors. The Indian economy remains resilient, and there are indications of a turnaround in earnings growth. This could encourage domestic investors to buy into the market, particularly if they can pick up high-quality stocks at discounted prices. Our experts will be weighing in on these developments throughout the show, providing their insights and analysis on what it all means for your investments. We'll also be taking a closer look at some of the key sectors and stocks that are being impacted by these trends. So, if you're looking to navigate the complexities of the financial markets and make the most of your investments, you're in the right place. We'll be exploring all of these topics and more in the coming segments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of finance and risk management, and today we're diving into some warning signs that investors should be aware of. A recent article caught our attention, highlighting the Shiller price-to-earnings ratio, which is currently hovering near an all-time high of 42. This gauge looks at market valuations over a 10-year period, adjusted for inflation, providing a broader perspective on the market. Now, it's essential to note that no two markets are the same, and this current market is certainly different from the one that led to the 2000 bear market. However, this high Shiller P over E ratio is a caution flag that should remind investors to be prepared. Historically, when this ratio has been this high, it's often preceded a bear market or correction. So, what can investors do to prepare? Firstly, it's crucial to identify stocks in your portfolio with abnormally high P over E ratios. These may be the hardest hit when the market experiences a downturn. Consider paring back some of those positions and diversifying your portfolio with holdings that tend to perform well coming out of bull markets, such as value stocks, international stocks, small caps, and high-yield dividend stocks. It's also important to ensure that your portfolio is reasonably valued and has strong, consistent earnings to support its price. Speculative stocks, or those that are overhyped without real positive earnings, could be more susceptible to a steeper drop if there is a market downturn. In terms of allocation, Vanguard's current model portfolio recommends 36% U.S. stocks and 24% international stocks, with 40% in bonds. Exchange-traded funds, ETFs, can also be a good option, as they come already diversified. Actively managed ETFs may be particularly useful, as portfolio managers can make changes to navigate the market's ups and downs. Ultimately, it's essential for investors to stay informed, be prepared, and maintain a balanced portfolio. By doing so, they can mitigate potential risks and take advantage of opportunities that may arise during a bear market or correction. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at the current state of home equity lines of credit, or HELOCs, and home equity loans. These financial products can be a great way for homeowners to tap into their equity and access cash for various purposes, such as home improvements, repairs, or even debt consolidation. Now, interest rates on HELOCs and home equity loans have been fluctuating, but currently, the national average for a HELOC is around 7.16%, while home equity loans are averaging around 7.35%. It's essential to note that these rates can vary significantly depending on your creditworthiness, loan-to-value ratio, and other factors. When considering a HELOC or home equity loan, it's crucial to shop around and compare rates from multiple lenders. Some lenders may offer more competitive rates, while others may charge higher fees or have stricter requirements. It's also important to understand the terms and conditions of your loan, including repayment periods, interest rate structures, and any potential penalties. For those with low primary mortgage rates and significant equity in their homes, taking out a HELOC or home equity loan might be a good idea, especially if you don't want to refinance your existing mortgage. However, it's vital to carefully weigh the pros and cons, considering factors such as your financial situation, credit score, and long-term goals. In conclusion, HELOCs and home equity loans can be valuable tools for homeowners looking to access their equity, but it's essential to approach these products with caution and thoroughly understand the risks involved. As always, we recommend consulting with a financial advisor or conducting your own research before making any decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.